Intro music fades in and then fades to a background hum. Hey everyone, welcome back to the channel. Have you ever looked at the stock market during a bull run and thought, wow, it seems so easy to make money right now? You see stocks soaring, everyone's a genius, and it feels like you can buy or sell anything in a heartbeat without moving the price. It feels incredibly safe, incredibly liquid. But what if I told you that a lot of that safety, that feeling of endless liquidity, is actually an illusion, a mirage? Today, we're diving deep into a concept that every investor needs to understand, the liquidity mirage. It is the phenomenon where massive injections of easy money into the financial system make markets appear far safer and more liquid than they truly are. It's like a desert traveler seeing a beautiful oasis that vanishes as they get closer. In the market, this mirage can lead to devastating consequences when it disappears. So, what exactly is liquidity? In simple terms, it's the ease with which you can buy or sell an asset without significantly affecting its price. Think about a stock like Apple. Millions of shares trade every day. You can buy or sell a few $1,000s worth, and the price barely budges. That's a highly liquid asset. Now, think about a rare piece of art or a vintage car. Finding a beer at a fair price might take months. That's an illiquid asset. In a healthy market, liquidity is a sign of strength. It means there are many buyers and sellers, all with different opinions on value, creating a robust and stable trading environment. But here's the twist. Over the last decade or so, we've lived in an era of unprecedented easy money. Central banks, like the Federal Reserve, have kept interest rates near zero and have pumped trillions of dollars into the economy through a process called quantitative easing, or QE. Think of QE as a giant fire hose of cash being sprayed into the financial system. This money has to go somewhere. Much of it flows into financial market stocks, bonds, real estate, crypto, you name it. This flood of capital creates a powerful effect. It artificially boosts liquidity. Suddenly, there are buyers for everything, not necessarily because the underlying asset is fundamentally sound, but simply because there's so much cash sloshing around looking for a home, any home, that offers a potential return. This is the birth of the liquidity mirage. It creates a false sense of security. When money is cheap and plentiful, investors become less disciplined. They take on more risk. They might buy into speculative tech stocks with no profits, or invest in complex financial products they don't fully understand. Why? Because the tide of liquidity is lifting all boats. It feels like you can't lose. You can always sell to the next person because there's always more money coming in. This environment also changes investor behavior. The fear of missing out, or FOMO, becomes the dominant market sentiment. Traditional valuation metrics, like the price-to-earnings ratio, get thrown out the window. The new logic becomes, it's going up, so I need to buy. This cycle feeds on itself. More buying pushes prices higher, which attracts even more buyers, creating a speculative bubble fueled not by fundamental value, but by the sheer volume of money in the system. The danger of the liquidity mirage is that it hides underlying risks. It makes fundamentally weak companies look strong. It makes risky assets appear stable. It's like putting a fresh coat of paint on a house with a crumbling foundation. From the outside, everything looks great. But the structural problems are still there, lurking just beneath the surface. So, what happens when the mirage begins to fade? What happens when the easy money spigot gets turned off? This is the critical moment where fortunes can be won or lost. Central banks can't keep interest rates at zero forever. Eventually, to combat things like inflation, they have to tighten monetary policy. This means raising interest rates and stopping or reversing QE, a process known as quantitative tightening, or QT. This is the equivalent of turning off that giant cash fire hose. And when the flow of easy money slows down, the mirage evaporates, often with shocking speed. Suddenly, that feeling of endless liquidity vanishes. Remember all those buyers who were eager to snap up any asset? They disappear. Why? Because the cost of borrowing money has gone up. Investors become more risk-averse. They start demanding real value, real profits, and real cash flow. The sell to the next person strategy collapses when there's no next person with cheap money to spend. This is when we see the true liquidity of the market. And it's often far, far less than what everyone thought. When everyone rushes for the exit at the same time, it's like trying to evacuate a crowded theater through a single small door. Chaos ensues. Asset prices begin to fall. Those who need to sell find there are few buyers. To attract a beer, they have to drop their price significantly. This triggers more selling as other investors panic, leading to a downward spiral. This is a liquidity crisis. The very assets that seemed so easy to sell a few months earlier are now impossible to offload without taking a massive loss. We saw this play out in 2022 as the Fed began to aggressively raise interest rates to fight inflation. The liquidity mirage of the previous years vanished. Speculative tech stocks, cryptocurrencies, and other bubbly assets crashed. The market suddenly remembered that fundamentals matter. The easy, guaranteed gains were gone, replaced by a harsh reality check. So, as an investor, how do you protect yourself from the liquidity mirage? How can you navigate a market that can swing from euphoria to panic so quickly? First, and most importantly, always distinguish between a rising tide and a well-built ship. Is your investment going up because of the company's strong fundamentals, its earnings, its competitive advantage, its growth prospects? Or is it just being carried higher by a wave of cheap money? Learn to do your own research and develop a strong conviction in what you own, independent of the market mood. Second, be wary of excessive hype and FOMO. When it feels like you can't lose and everyone around you is getting rich quick, that is often a sign of maximum risk, not maximum opportunity. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. The liquidity mirage is pure greed. Third, understand the macroeconomic environment. Pay attention to what central banks are doing. Are they printing money and lowering rates, creating a tailwind of liquidity? Or are they tightening policy, creating a headwind? This context is crucial. The same investment can be a great idea in one liquidity environment and a terrible one in another. And finally, maintain a diversified portfolio and don't over-leverage. Diversification helps ensure that a sudden crash in one asset class doesn't wipe you out. Avoiding excessive debt means you won't be forced to sell your assets at the worst possible time during a liquidity crunch. The liquidity mirage is a powerful and seductive force in modern markets. It makes us feel smarter, safer, and richer than we are. But it's an illusion built on a temporary foundation of easy money. The savviest investors are the ones who can see through the mirage, who focus on real, enduring value, and who are prepared for the moment the desert oasis inevitably reveals itself to be nothing but sand. Understanding this concept is key to long-term survival and success in investing. Don't let yourself be fooled by the illusion of safety. Build your portfolio on a rock-solid foundation of quality and discipline, and you'll be able to withstand any market weather, whether the tide of liquidity is coming in or going out. Thanks so much for watching today. I hope this gave you a new lens through which to view the markets. If you found this valuable, please hit that like button and consider subscribing for more deep dives into the world of finance. Drop a comment below. Have you ever been caught in a liquidity mirage? Let's discuss. Until next time, invest wisely.